right. Hello, and welcome to today's webinar, Public Banking and the Just Solutions Affordability Framework. I'm Jennifer Moon, Senior Researcher with Just Solutions, and my pronouns are she, her. And to start out today's webinar, I'll let you know that it is being recorded, and we will be making the recording and the slides available to you following today's session. Next slide. All right. If you are not familiar with Just Solutions, we are a nonprofit organization that partners with environmental and climate justice state level coalitions and organizations to advance climate solutions that support healthy, resilient communities and accountable democratic institutions. We regularly convene state and national policy organizations across issues and movements to strategize, innovate, and replicate policy models and solutions. And we also conduct actionable research and policy analysis, as well as providing technical assistance and legal support to advance partners' priority campaigns. And we offer educational programming, such as today's webinar. Next slide. So we have a full agenda today, and in a moment, I'll be providing an overview of the Just Solutions Energy Affordability Framework. And then we'll be hearing from our three panelists, followed by a Q&A opportunity. Please put any questions you have in the chat, and we will try to get to as many of those questions as possible following the presentations. Next slide. All right. So we hope that today you'll come away from the webinar with a better understanding of the history and one slide back. Yeah. One more back. All right, great. We hope that you'll come away with a better understanding of the history and objectives of public and green banks, as well as their various organizational structures, greater awareness of existing resources and recent developments in public and green banking with a focus on efforts in California and New York. And then finally, we hope that you'll be inspired to think about opportunities for growth and replication of public and green banking at the state level. Next slide. Okay, so a little bit about our energy affordability framework. Over the past several months, Just Solutions has been exploring pathways to energy affordability in the context of climate justice. In August, we launched States Lead the Way, affording our energy future, which is a national effort involving state climate justice coalitions and organizations working nationwide to highlight affordability in clean energy conversations and to build momentum for replicable state strategies to move an equitable and affordable clean energy future forward. So we developed the Energy Affordability Framework, examining the drivers of unaffordable energy and strategies for achieving affordable energy. And our report looks at who is most affected and policy solutions that hold promise for improving energy affordability, including model policy features and examples from states that are engaged in the development and implementation of model policies. These solutions include four core policy areas: household protections, so things like utility bill assistance, disconnection protections, utility outage compensation, and low-income utility rates; residential decarbonization, including home electrification, demand response programs, plug-in solar, solar plus storage, residential building codes and community solar; utility reform with a focus on transparency and accountability, cost containment, and policies to facilitate the clean energy transition. So this includes things like performance-based regulation, utility bill transparency, and cost containment related to data centers and other major loads. And then finally, funding and financing. So recognizing that states have balanced budget requirements and budgetary constraints, we wanted to examine options states might have to finance policy innovations that advance energy affordability, particularly in light of the pullback in funding at the federal level. We also developed an accompanying policy library which you can find at the site shown on the slide, that details model state policy approaches related to each of these four core policy areas. And this is a resource that currently contains about 40 policy solutions. We continue to add to it and update it as new policy solutions emerge. And so we encourage you to check those out and to reach out to us to learn more about our work in this area. Today's focus is that fourth energy affordability policy area, funding and financing, and specifically the role that public and green banks, as well as other financing partners, can play as financing mechanisms for an equitable clean energy transition. So we'll be looking at the history of public and green banking, various organizational structures, as I mentioned, existing resources and what's going on in public and green banking in California and New York, and opportunities for growth and replication at the state level. And today's webinar is also the launch of our Energy Affordability Spotlight Series. Over the next few months, we'll be taking a deep dive into various energy affordability topics through monthly webinars. So look for upcoming announcements about that. Next slide. Okay, and with that, I would like to introduce our first speaker, Devin Case-Ruchala. Devin's academic studies have focused on key issues related to the history and structures of public and green banks. And so, Devin, I'll turn it over to you to get us started.
Thanks, Jennifer. Share my screen. All right, seeing my screen? Great. Okay. Well, hi, everybody. Thank you for being here and to Just Solutions for the invitation. Like Jennifer said, I'm going to give a broad intro and background to public banks and green banks as one set of tools for investing in projects and infrastructure that help deliver more affordable clean energy. And I'll be drawing on the research on public bank formation that I did for several years while I was getting my PhD in political science a few years ago. And prior to that, I had worked at a CDFI loan fund, and I've been working with green banks the last several years, which I had learned about through the dissertation research that I did. So this overview I'm giving is bringing together all of that background research and experience. So just as a quick overview, I'll start with definitions so that when I get to the why of public and green banks, you actually kind of know what we're talking about. And then I'll get more into that, kind of why we're here talking about it, on the history, and then to like, what do we know about public banks and green banks in general in relation to affordable clean energy, then turn to some examples and resources. And of course, the other panelists will be adding more detail on the specific contemporary models given their expertise working in the sector. So jumping right into definitions. So a public bank can be defined as it's a financial institution, not necessarily a bank, but a financial institution. It could be commercial, investment, development, savings, postal banks, any kind of financial institution can be a public bank. But it's at least 50% government owned or controlled. And then there's a category, quasi-public banks, that can be considered to be at least 20% government owned or controlled. A green bank is could be seen as kind of a subset of public banks and another set of financial institutions structured as nonprofits that primarily invest in clean energy or other environmental benefits. So they have a mission and investment focus on that. So yeah, they can take on different structures, primarily public or quasi-public, nonprofit, and that can include community development financial institutions. Typically, they're not deposit taking or structured as private banks. There's some exceptions outside of the US. These are not formal legal definitions. I just want to mention that because they're not, you don't need to think of them as kind of like hard and fast definitions, but they're concepts that have developed over time through a lot of kind of research and policy proposals and debates. But these are kind of the common ones, and consistency in definition is important for policy discourse because basically it allows us to compare apples to apples, right? So if you're assessing the financial performance of a green bank versus, let's say, like a grant program, that's going to be very different kind of analysis and get a very different kind of assessment of the impact of it. So that's the kind of level setting there. So here's another way to visualize it. So like I said, there's can be overlap. There can be public green banks. There can also be green bank CDFIs, where CDFIs can be defined as a mission-driven institution that at least 60% of its investment goes to low-income communities or other target markets. And then any green bank that's not a public green bank or a CDFI green bank, like I said, in the US, typically they're structured as a nonprofit. So these are all distinct from especially, other kinds of financial institutions or funding sources like private banks, credit unions, community banks, um, government agency, although there are some CDFI credit unions, um, but especially government agencies and grant programs, it's really something distinct from these kinds of institutions. And like I said, it matters for things like impact analysis and policy discourse, because if you're talking about the performance of a grant program versus a public bank or a green bank, that's kind of, yeah, comparing two different kinds of entities. So why are we talking about public banks and green banks? And I'm kind of asking this as like a big why. And I want to set the stage with a historical perspective for two reasons. One is to understand the kind of US specific circumstances that have shaped the contemporary public and green bank movements and the narratives around that within the much broader history of public banking. Um, so doing so helps to basically contextualize the current movement as one expression of a much longer tradition and shows how public banks and then green banks as an extension, partial extension of that, they're a long-standing practical policy tool that governments globally have adapted to a wide range of objectives and contexts over time, rather than being a kind of niche or uniquely contemporary policy innovation, which like sometimes kind of current discourse can kind of frame it as that. So that being said, that's kind of motivation for going into a bit of the history here. So that being said, the current the current public and green bank movements in the U.S. can be traced back to the 2008 financial crisis, where, with the financial markets and the broader economy being in free fall, the policy response at the time was to bail out the big banks with the $700 billion TARP program, which was later reduced to 500 billion. But in any case, those were big numbers at the time. They may seem like not as big of numbers today after all of the kind of COVID stimulus packages that came out. But at the time, it was really unprecedented and really, really shocking. And in terms of public reaction to this, for a significant portion of the public, the reaction to this policy response was not favorable, sparking the Occupy Wall Street movement and so on. And so this was also a time when there was a lot of innovation in policy thinking, because that's what happens in crises, right? The old prevailing economic model is threatened, it's thrown into question because of the crisis circumstances, and that creates a window for consideration of alternatives. And so this included proposals for public banks and green banks, the idea there being that there could be a new kind of financial institution that has a different incentive structure and that would also help as part of the economic recovery in the wake of the crisis. So some of the key points about public banks in particular being it's a public purpose, has a public purpose and mission. It can invest in lower cost, longer term investments, which is called patient capital. It can leverage additional capital from the private sector or other sources of public funds. It can have specialized expertise, meaning underserved or emerging sectors that might be overlooked by the private sector for various reasons. And they're self-sustaining, so the returns are recouped and then reinvested over time. And for all of these reasons, there'd be more development going into the real economy as opposed to speculative bubbles. And I want to briefly point out that in the decades kind of leading up to the crisis and this kind of renewed thinking on different models and different policy responses to the crisis, there had been in the US effort to pass policies that would try to orient private banks more to local communities and the inequalities produced, especially by the legacy of redlining practices by private banks in the 1930s and 60s. So specifically, the CRA was passed to require that banks lend to all the communities in which they operate. And then later, the CDFI fund was passed, which created the CDFI designation, which allowed for all these CDFI intermediaries to be created to help serve local markets and also help private banks reach local markets to basically be able to go towards their CRA regulatory requirements and their exam reviews. So just as one example here, Goldman Sachs has this 10,000 small businesses program where it partners with CDFIs, and that kind of investment and partnership could go towards its CRA exam review. There's a lot more that could be said about this, but just the point that I want to make here is that this laid an important foundation, and CDFIs do important work, and that work has only underscored the need for community investment, especially in the wake of 2008. And so when we talk about public banks and green banks, we can, both in 2008 and now, we can think of them as additional models that kind of layer onto this regulatory background and the work that CDFIs do. And I'll circle back to that at the end because, CDFIs are increasingly doing clean energy lending, and there's at least one example of a CDFI green bank. But going back to 2008 and the public bank and green bank kind of policy ideas. So in particular with public banks, the proposals for public banks were rooted in, for the most part, precedent in the US, which is somewhat kind of limited because there's only a few models historically that we can point to. So one is the Reconstruction Finance Corporation, which was created as part of the New Deal and the economic recovery coming out of the Great Depression. That itself was modeled off of the earlier and less frequently cited War Finance Corporation, which had provided more borrowing capital to domestic industry following World War I. And that in itself had been influenced by even earlier models, both within and outside of the US. And then there's the most frequently cited model, the Bank of North Dakota, the founders of which would have been familiar with Scandinavian cooperative and public ownership models back when it was formed in 1919. But it's still in operation today. And it operates as more of a traditional bank in the sense we typically think of it as, in terms of taking deposits and giving consumer loans, but also financing infrastructure projects. And I think Sylvia will cover that in more detail, so I'll kind of leave it there. But as I indicated earlier, these are the often cited models in the US, and there's relatively few of them. And so the point I want to kind of briefly make here on public bank history is that public banks have a much, much longer global history. And going back to the 1400s in medieval Europe, as states were developing and financials were developing and kind of co-evolving. And then today around the world, there are many models across a variety of regime settings, a variety of economic development levels. And this is just, a random sample on the right, some examples of those. And there are a few historical examples of specifically environmentally focused public banks, although there are many public development banks that increasingly focus on sustainable development. So this broader history, if you're a history buff and you want to jump down the rabbit hole, you can go to my website. There's a lot more on the history and data that I pulled together for my dissertation research. But this chart here shows this longer history in Western Europe, and then also the way that so this is plotting the start and end dates that public banks were created over time across different regions with shading in between. So the darker shading indicates when there are more public banks in operation. So we see that longer history in Western Europe, but then also in Africa, Southeast Asia, in the context of decolonization, and in Latin America and the Caribbean in the context of post-World War II import substitution industrialization development policies. And then, as we can see, less in North America. So like I said, if you want to jump down the rabbit hole, there's a lot more you can go check out. But point being that there's a lot of precedent for public banks globally, and that predated and fed into those early US models. So if we're in the big why of why we're talking about public banks, right? It's kind of in that much longer historical context. And And those US models from the 20th century are kind of the more immediate reference points for public bank proposals that were coming out of the 2008 crisis. Um, but as we all know, right, there wasn't a national public or national green bank created after 2008, and instead that didn't become part of the policy response to the crisis. But instead, that the emphasis kind of turned to the state and local level, where there's local public and green banking movements that emerged. And so this is just a snapshot from the Public Banking Institute website of where there's active campaigns, public banking groups, or public bank established across the US. And then similarly, in the last couple of decades, there's been a lot of growth in the development of green banks at the state and local level. So you can see on the left here, this is showing green bank formation over time, structured as public, quasi-public, and nonprofits. So a huge amount of growth in the last 2 decades, and it's kind of giving you an indication of the geographic distribution of those across the US. So that's the kind of the big background, and so now the question, what do we know from this history, from these pre-existing models? Because especially the move to the state and local level really provided an opportunity for kind of experimenting and proof of concept of these models that kind of didn't quite bear out in the post 2008 context. So in general, at the end of the day, these are institutions. Are not inherently good or bad. Especially public banks, like the policy and economic context affects how they form and operate. If you're looking at, all over the world over time. And the founding mandate, so the way that they're actually legally set up, what their mission is when they're formed, that can really matter to how they evolve over time. But at the end of the day, they're institutions and mission drift is possible. So there's been some research around, those specific structures and mission drift and that kind of thing. But typically, once they're formed, they grow and they remain in operation for many years. So this was, again, part of my research. Once I pulled together that global data set and historical data set, I could take a look at even if a public bank is formed through nationalization or formed de novo through legislation or other ways that public banks have formed over time, on average, if you look at average across all of them, it's about 50 years that they remain in operation. And then we can see on the right that green banks, since a lot of them have emerged, 15 years ago, have grown in the amount of investment that they collectively have invested, both from their own asset base, but also mobilizing private capital into clean energy technology. So, and the right-hand side is referencing a white paper that I wrote last year, which I think these slides will be sent out, so you can find that. And in relation to affordable clean energy, we can talk about specifically what green banks do. So, there's different models; they do many things, but if we were to condense it down, it's kind of several core things that they help do that kind of distinguish their role from private banks and other kinds of financing institutions. So they help lower perceived project risk, and that could be because of the type of transaction that they provide and where they sit in the capital stack. So it would be providing a credit enhancement or loan loss reserve. They also take on first-in-kind transactions, so that learning over time how to do new transaction structures and new projects, they can, over time, develop that expertise into streamlining the cost and the complexity of those, which makes it kind of more intelligible to a wider set of financing institutions. Similarly, inefficiencies of scale. So as that complexity gets streamlined and there's more standardization over time, you can start to have aggregation into portfolios the way you see in the mortgage market, auto loan market, et cetera. They also offer marginal economics, so they can provide gap financing to de-risk private investment, which basically means if there's a portion of the financing that they can fill that would, without that, the private investment would be a lot more kind of hesitant, or the risk would be perceived as too high, then kind of green banks can kind of fill that role. They also can work around customer financial constraints and provide innovative solutions such as on-bill financing, which is financing renewable energy upgrades, efficiency upgrades through the utility bill the customers pay. And they can also just serve as a central resource. So, right, like the clean energy markets in particular can be really complex. You have developers, you have local regulations, different financing options, and green banks can kind of house that expertise and serve as a centralized coordinator. And when I say green banks, that includes public green banks, and it includes, a public bank that might want to focus on this kind of lending. So in short, they take on risks, costs, and customers or projects that historically have been less attractive to traditional banks. And they can also initiate and help mobilize more investment into clean energy projects. So there's different, like I said at the beginning, different structures. So just to get a little bit more into what that entails and what some of those trade-offs are, with some kind of examples on the right. For public and quasi-public banks, so those can benefit from having state backing of being kind of like the official recognized green bank of the state. And sometimes they get initial seed capital, or there's part of the founding legislation kind of directs a revenue stream, so they have a continuous source of capital that gives them more funding stability. Um, on the flip side, they might remain a little more closely tied to state policies. Like there can be a much longer startup time. The amount, just getting legislation passed to create one can take longer than, for example, creating a nonprofit, which operates independently. It can avoid those kind of policy constraints or bottlenecks. But though, on the other hand, nonprofit green banks are more reliant on philanthropic and mission-driven capital because they're not getting that initial, seed investment or some kind of other guaranteed revenue that's facilitated by legislation. So they can face challenges in securing sustained capital. And then, like I mentioned, there's increasingly hybrid models where, it's the same kind of situation as the nonprofit green banks, but they might have enhanced lending capacity to serve underserved markets because that is kind of the focus of CDFIs, and as well as having the CDFI certification that can unlock new capital sources, such as partnering with private banks for the CRA lending or through the CDFI fund. I put a note at the bottom here. It's more like if you want to Google it, there's a special designation for state agencies or public state green banks called a SEFI that also kind of unlocks other types of federal funding. But I'm not going to go into that too much more. So across these different institutional structures, green banks get capital from could be city, state, and county appropriations if they're public. Could be philanthropic and private investments. If they have a bond program, then it could come from individuals. It could also be grants from state level agencies or federal agencies, or it could be kind of other nonprofits, national CDFIs. So that kind of gives you a sense. It's a wide range. All right, going into some specific examples of each of these, so you have kind of a concrete understanding what this looks like. So an example of actually quasi-public green bank, the Connecticut Green Bank, is one of the older ones, founded in 2011 through state legislation. And that legislation also enabled a $30 million annual funding base. In 2024, just to give you a sense of scale, they had 51 million in investments with an additional 393 million in private capital that went towards clean energy projects, and 40% of that was to vulnerable communities. They have a Smart E program, which basically is a standardized residential energy efficiency loan product. So that goes back to the standardization piece I was talking about earlier. And they also have the Green Liberty Notes, which is helps support the loan purchases of small business efficiency upgrades. A nonprofit example is Michigan Saves. It's founded in 2009. Again, to give a sense of scale, in 2023, Michigan Saves invested around 130 million in residential and commercial projects. They use on-bill financing, so this is where customers pay for efficiency and renewable energy upgrades through their utility bill. And they've reported that this has resulted in a $400 average household utility bill savings for their um, communities that they serve. Example of the hybrid model. So right now it's really just Self, which is based out of Florida and serves the Southeast. It was founded in 2009. They've invested in 2023, they invested around 34 million in loans, and 95% of that was serving low and moderate income customers. And they've developed what they're calling the plug and play product, which is basically offering standardized underwriting for home improvement loans. And this has been adopted by multiple other green banks nationally. And they've reported that their work has resulted in 23% average utility bill savings. And there's other kinds of partnerships. So I just mentioned a few here. The New York Green Bank has a community decarbonization fund, which I believe Erangi's going to talk about that more. So that sets aside money for CDFIs and others. The DC Green Bank and many other green banks have done co-lending with CDFIs. The Collective Clean Energy Fund, which is based in Colorado, has underwriting partnerships with local credit unions. So kind of as I was level set in the beginning, right, this is all kind of increasingly part of one ecosystem that's including public and green banks as well as kind of the existing work that CDFIs do. So some resources. Public Banking Institute has a lot on their website. I also want to throw out the Public Banking Project and Municipal Services Project. This is a Canada-based organizations, but they've done a lot of research on different models and of public banks. So just kind of wanted to point people there if you're looking for more on public banks. And then for green banks, there's if you want to kind of get a sense of existing green banks in the US, there's the US Green Bank 50, and that'll give you a complete list of all their members. I think they've got some resources on their website. Public sector consultants could be a resource. They've worked closely getting green banks stood up in many states, and they have a kind of resource set or like a designated kind of line of their work that's tailored towards green banks. So I just kind of threw that resource up there. Center for Impact Finance also has done a lot of research historically on CDFIs, but increasingly as well on green banks and clean energy financing. And then CDC is a national green bank that had played a role over the last couple of decades incubating and helping start up several green banks. So websites there's a lot of resources and history with CGC as well. Thank you. So I'll stop there and turn it over to the other panelists. Like I said, there's more on my website, and welcome to reach out to me on LinkedIn.
All right, thank you, Devin. And now we'll hear from Sylvia Chi of the California Public Banking Alliance to speak to California.
All right. Give me 1 minute while I figure out the sharing. Okay, I think that is working. All right, so thanks everyone for joining. I'm Sylvia Chi. It's great to be back here with Just Solutions and see a lot of familiar folks' names in the participation list. So as many of you know, I used to work here at Just Solutions. But and I was the legal and advocacy director here working on environmental and climate justice policy. My background and training is in environmental law and policy, especially climate, energy, and environmental justice issues. But today I have my public banking hat on. This is an area I've been working on basically as my volunteer side project hobby for about 8 years. So I don't have formal training and professional experience in finance, and I'm bringing my perspective as a policy advocate and activist. So I cannot answer any really complicated questions about finance, but hopefully someone else can. So as Devin mentioned, a lot of the roots of public banking in the US came out of Occupy. In California, the current movement really took off around the 2016, 2017 movement to block and divest from the Dakota Access Pipeline, and inspired by the water protectors at Standing Rock. And And that's how I got interested in this area. So I live in Oakland, California, and it so happened that at this time, our city council was voting on whether to renew their contract with Chase. And so I, along with several other local activists, spoke at the city council, asked them not to renew. They were persuaded, but long story short, we came to understand that there was really no other options for relatively big cities like Oakland to for banking, other than the mega banks that finance DAPL and or other harmful investments. So I joined up with the public banking group in Oakland, which is now called Public Bank East Bay or Friends of Bank East Bay. And that had emerged out of the Occupy movement. And so I started working with them to see if we could make a new publicly accountable public bank that could hold the city's deposits. And we linked up with other groups from around the state that were similarly motivated and created the California Public Banking Alliance. And it's all grassroots and volunteer led. We used to say it was like 100% volunteer, but we do work in partnership with a handful of nonprofits and unions. So I want to recognize that. Um, but today the California Public Banking Alliance connects local groups all across the state from San Diego to Humboldt County. So Devin mentioned a little bit about the history of public banking in the US, and this, we don't have time to go into all the detail, but I do want to talk a little bit about the Bank of North Dakota. This is setting aside the banks owned by the tribal nations because of their unique tribal sovereignty. There otherwise are two main examples of public banks in the US, the Bank of North Dakota and the Territorial Bank of American Samoa. Um, American Samoa's case is also not really easy to analogize to anywhere else in the US because it's also a very unique situation. But that was established just 10 years ago. And as we've already mentioned, the Bank of North Dakota has been going strong since 1919. So a little more detail about the Bank of North Dakota. Um, it is primarily a wholesale bank. They do some like kind of retail services, but their focus is wholesale. So it's often talked about as like a banker's bank or kind of like a mini central bank. And it holds all of the state's deposits. It also holds, I believe it holds some local government deposits, but not all of them. I think it's an option for local governments in North Dakota. And they partner with local community banks and credit unions to offer loans. And the main areas that they offer loans in are small business, agricultural, disaster relief, and student loans. And just a kind of unique feature about them is while they hold deposits, unlike most banks you're probably familiar with in the US, the deposits are not insured by FDIC, the Federal Deposit Insurance Corporation. Instead, the deposits are guaranteed by the state. And it is a public institution owned by the state, and it's governed by their industrial commission, which consists of the governor, the attorney general, and I think it's the agricultural commissioner. Um, but in general, it has a really strong track record of positive performance for many decades, and historically has been run in a very conservative, meaning risk-averse way. Um, and it seems to have a really good reputation among North Dakotans, and especially among the community bankers and credit unions there. And that's largely because the participation loans and the other ways that they partner with the local financial institutions helps those local financial institutions multiply the impact of their lending. And it really pays off in terms of the impact for the local economy, in terms of investments in small business, and in the specific case of getting those payroll protection program loans out. during the height of the COVID crisis. They had a really good record there. So in 2019, as part of the California Public Banking Alliance, I helped to write a law that was basically trying to make it as similar as possible to the existing law for like conventional private sector banks that would allow local governments to apply for a charter, basically a license from the bank regulator, with the idea that there wouldn't be special treatment for public banks, so people couldn't say like you're letting them act, you're letting public banks take on more risk than private sector banks. Um, and we baked in some of the concepts from the Bank of North Dakota model, so that the law prohibits local public banks from providing direct retail services to customers, like opening a checking account or getting a loan. So instead, those types of services have to be offered in partnership with local financial institutions. And there is a caveat there where, like, if there are no local financial institutions in the jurisdiction that are offering that particular product, then a local public bank could offer that product directly if that situation comes up. Um, and then, unlike the Bank of North Dakota, our authorizing law includes a requirement that these local public banks carry FDIC deposit insurance. That was a compromise amendment we had to accept in the legislative process to keep the bill alive. And then we also still kept the requirements for collateralization in place. That's still a big challenge to the business model for public banking. And that just means like public deposits in California by state law have to be securitized. So there has to be at least 100% security for public deposits in a bank account. So that's the sketch of the law that we passed. The governor signed it in 2019, and then that was in late 2019, and then COVID happened. It took a long time for the state to get around to developing and finalizing the regulations. So those were not finalized until late 2021. And then the law, like we also had to take another compromise amendment that would sunset the law in 2028. So we're trying to rush to meet that deadline, and we don't have a lot of time left. So that's what we got done in 2019. What have we been doing since then? We've been working, at the local level in many different parts of the state. And local government budgets have been very challenged since COVID, as I'm sure many of you know. So we're not seeing the kinds of local government budget surplus years that we did before COVID. There's a lot of, budget deficit problems in a lot of different areas. So we've been just slowly organizing and building political capital at the local level. I could talk a little bit about San Francisco and East Bay. Um, in San Francisco, I was a member of the reinvestment working group that the Board of Supervisors put together a few years ago, and we developed these business plans for San Francisco, and we came up with the idea that we would start with a green bank and try to operate that for a few years and get some experience, build confidence, and establish a track record of performance, and then transition to a full depository public bank. And through that business plan process, we did a bunch of community engagement and focus groups and determined that the main lending areas that are priorities in San Francisco are, unsurprisingly, affordable housing, small business, and clean energy and climate investments. these were the areas that we found were, had needs, financing needs that were not being met by the private sector. And we are moving forward to put a charter amendment on the November ballot that will ensure the independence of the bank. So this is going through the Board of Supervisors process right now. So it's not certain, but we're hoping that by the end of the month that will get approved, and that will make some changes to the charter, ensure independence, and try to make sure that like the governance of the institution is really solid and is set up so that there isn't the kind of mission drift problem that we often see. And then in the East Bay, they're also moving forward um, with a ballot measure this November. There is going to be, or they have collected the requisite number of signatures to put a parcel tax measure on the ballot in Berkeley in November. And that will generate revenues to help capitalize their public bank. I just wanted to briefly also mention Cal Account, which is another program that CPBA works on in partnership with a bunch of other entities. And this is basically a universal public option for basic financial transaction accounts. And the way it would work is basically like a fintech app layer in partnership with the bank, which in the future could be a public bank. But the idea is that it would be available to anybody, and provide basic accounts with no fees, no minimum balance. It would accept direct deposits and allow bill payment and cash transfers. So we passed the commission bill in 2021. And then the commission met for about a year and oversaw the development of this blue ribbon commission report that confirmed feasibility of the program. And we're currently working with the state treasurer's office to plan implementation pilots in San Francisco, Los Angeles, and Fresno. And then this year, CPBA introduced the State Bank Act, and this is AB 2243. So CPBA really wanted to run this bill to create a state public bank. This bill creates an independent commission to oversee developing a plan for the state public bank. So it doesn't create the bank itself. It's a similar approach to Cal Account in that way. And we laid out a whole bunch of things that we want the commission to address, and then also to require public hearings to solicit feedback from the public and to inform that plan. It's a very fiscally challenging year in California. And even though the state ended up with, or there's expected to higher than expected revenues collected, but there's still a lot of like major cuts and harms that are coming from the federal government. So it's just a very contested year and difficult to do ambitious things. So the bill passed through two committees in the Assembly, and then got held in appropriations. And then just to kind of sum up about public banks and energy affordability, I think Devin kind of addressed this a lot already, but in general, what public banks can do to help with energy affordability is just provide lower cost capital, and in large part that is driven by the fact that there is no profit margin. And some examples for like what that could be used for is upgrading transmission lines and substation equipment. And there is, for example, a similar program, or the state of California just is starting a new public financing program for transmission equipment. So, this is a definite need. it could be used for deploying things like community solar, microgrids, batteries, and heat pumps. And then public banks can incorporate social policy goals like prioritizing lending in environmental justice communities, installing solar and storage at schools, libraries, community centers, resilience hubs, etc., and like retrofitting rental properties. And then you can also incorporate some like, these green goals into other areas of lending like small business and housing. And I've provided some examples for that there as well. And that's it. So that's also my LinkedIn in case you want to get in touch, and I will hand it back.
All right, thank you, Sylvia. Just to draw everyone's attention, there's an update about Berkeley having that its signatures are sufficient, and a little bit more information about the California effort there. Next, we'll hear from Erangi Dias of the Nonprofit Finance Fund.
Alrighty. Hi, everybody. It's great to be here. Just making sure everyone can see my screen okay. I'm getting some nods, so that's great. So, hello, everyone. My name is Erangi Dias. I am the Senior Director of Environmental Finance at the Nonprofit Finance Fund. Just quickly about me, I started at the Nonprofit Finance Fund last year, and prior to joining NFF, as we call ourselves, I spent almost a decade in the world of green banking. I was at NYSEG, New York City Energy Efficiency Corporation, which, when it started, was sort of considered the green bank of the city of New York. So let's jump in to the presentation I have here. So just a little bit about NFF as an organization. We are a community development financial institution. I'm sure you've heard about with prior presentations here on this webinar. We have been around for 45 years. We have a nationwide footprint. We're headquartered in New York City and have 5 offices in Boston, New York City, Philadelphia, Oakland, and LA. NFF operates through 2 primary pillars. One is the financing arm that basically puts out capital, primarily in the form of debt. And the second arm is the consulting arm that provides financial consulting to nonprofit organizations. So across both pillars, our mission is basically the same. It is to support nonprofit organizations so that they can support the local communities that they exist to support. Just in terms of a quick snapshot, our tagline at NFF is Money Meets Mission, and this page sort of attempts to summarize that, what we've done in terms of impact. We ended 2025 with an outstanding portfolio of about $350 million. I won't go into each of these, but this is some of the examples of impact that we've had. Moving on to green lending at NFF. So NFF interestingly began as the Energy Conservation Fund decades ago with the goal of helping nonprofits with their escalating utility bills. And in the many years that followed, the organization sort of organically moved away from energy into doing a lot of other things. And so last year was sort of a full circle moment for NFF because NFF in our current strategic plan committed to the environmental sector and to supporting the environmental sector. We officially launched a program and I joined last year to lead that program. The goal of the program is to support projects that generate environmentally positive impacts and thereby support local communities. So where sort of NFF is very relevant to this conversation is that last year we received a $25 million award from the New York Green Bank under the Community Decarbonization Fund, which was mentioned earlier. This award, which was sort of the only exclusive form of capital for our new environmental finance program, has been the cornerstone of the work that we've done so far, and has been just catalytic, I would say, tremendously helpful in getting our program off the ground. I will just mention that at the same time as roughly we were expecting this award, we were also expecting funds from GGRF, which course, as we all know, did not come through. But this New York Green Bank did come through for us, and the award they gave has just been so helpful. So this is a little bit about the New York Green Bank's Community Decarbonization Fund. It is a $250 million wholesale lending pathway that is available to CDFIs and other emission-driven lenders. You sort of see the diagram at the bottom, kind of shows how the Green Bank has this pot of $250 million. They lend out to CDFIs that then on lend to eligible projects. So there are certain eligible technologies. They're basically greenhouse gas reducing technologies. And the other thing that's really important to mention is that these projects have to be within disadvantaged communities across the state of New York. So, so these 12-year loans are provided to us at a concessionary rate, and therefore we on lend at a concessionary rate as well. I'm just moving ahead here. This is the sort of NFF's first year impact in the sector from the funds that we received through the CDF. This is just the first year of 12 years. But we have in that first year greened 748 affordable housing units and supported 700 students in schools by greening the schools. The products we've used are listed here. Our primary sectors so far have been affordable housing and education. And I think what I'll stress here, because I know we're sort of close on time, and maybe we'll just leave a couple minutes for questions, is that as CDFIs, we're very familiar with working in disadvantaged communities. It's where we have our relationships. And so to be able to overlay this capital that we got from the New York Green Bank to what we already provide was I think very smart from the Green Bank's perspective, and two, very efficient. And it's why we've been able to get out as much funding as we have in the first year of deployment. We've got about half of our award out. This is just, I won't go into this slide, but it sort of shows the two pillars. Our program, our environmental finance program at NFF, seeks to do decarbonization, which is what the Green Bank work is about. But we also look to support environmentally focused nonprofits through working capital support, etc. And this is just my contact information if anyone would like to get in touch. And with that, I will end there.
All right, thank you. I think we can handle maybe one or possibly two questions. We have one here, probably for Devin. Can public banks use publicly owned assets as collateral to enhance their balance sheets and thus their money creation power through lending?
Yeah, I think that was something that Sylvia mentioned. So certain models can do that. There's a lot of different models. It can really depend. Some are, formed to be sort of they're government owned but quasi-independent. But yes, my understanding is that they can. I don't know, Sylvia, if you want to speak more to that. Oh, you see.
That sounds right to me, but this is above my pay grade.
Mhm.
Thanks. And Sylvia, there is a question about the state bill being reintroduced under a different name, author, and number.
Um, still too early to say, because we'll check back next year. We'll see.
And I think you were talking about creating banking at the hyperlocal level. The question is, would a nonprofit green bank be more possible at a smaller hyperlocal level, or is the difficulty the same? Do you have anything else to add about that?
I think that is theoretically possible. I think it depends on, where it is, where this hyperlocality is. And I think the difficulty has a lot to do with like capital sources. Um, but yeah, that's my impression.
Okay, thank you. So I would encourage you for any other questions to reach out to our presenters or our selves at Just Solutions. And as we come to the end of our time, I'd like to thank all of our presenters today. It's a great presentation. And thank you to our attendees for your interest. We have a link to thank you. Angel. We have a link to a post-webinar survey here in the chat. And we hope that you'll take a minute to complete that to give us feedback about today's session. And you can also look for a follow-up email in the next few days that will include the webinar recording and the slides, and look for upcoming announcements about the next topics in our monthly Spotlight series. So I'd like to thank you. Keep an eye out for more work in our States Lead the Way work. And thank you for attending, and have a great rest of your day.